It wasn't the trade deficit, it wasn't the manufacturing data, it wasn't even the tech earnings miss. It was the sudden realization that the collateral underpinning the global financial system is no longer mathematically viable. The headlines are focused on Beijing, they talk about currency. Pegs, they talk about export controls, they talk about the sell-off in U.S. Treasuries, but these are merely symptoms. The disease is structural, the disease is historical, and the disease is terminal. The pattern is unmistakable. We are watching the mechanical unraveling of a hegemonic currency. It happens when an empire overextends. It happens when the cost of maintaining dominance exceeds the economic output of the citizenry, and it happens when a rising rival finally calls the bluff. This is not a political opinion. This is accounting. The arithmetic is merciless. When the dominant power relies on debt to fund its own consumption, it becomes vulnerable to the creditor. For decades, the United States has enjoyed the exorbitant privilege of printing the world's reserve asset, but that privilege has a shelf life, and current data suggests that expiration date has arrived. To understand where we are going, we must look backward. History provides the roadmap. The names change, the technology changes, but the incentives remain exactly the same. We will examine three specific historical precedents, three empires that reach the exact same breaking point, and we will see how the external shock, the trigger from a rival, was merely the final push over the edge. First, consider the Roman Empire, specifically the period leading into the crisis of the 3rd century. By the time of Emperor Nero in the 1st century, the cost of empire had become unsustainable. The legions required payment, the bureaucracy required funding, the public demanded bread. In circuses, the math didn't work, the tax base could not support the expenditure. So, the state chose the monetary shortcut. They began to debase the denarius. They mixed copper into the silver. They thought they could print prosperity. It worked for a time. Liquidity increased, asset prices rose, but the rot was setting in. By the time of the soldier emperors in the 3rd century, the currency had lost nearly all its silver content. Inflation tore through. The empire market ceased to function. Soldiers demanded payment in goods, not coin. A common laborer found that his wages could no longer buy a week's worth of wheat. The middle class was hollowed out. Wealth fled the cities for the countryside, locking capital into hard assets like land and fortified villas. The social contract fractured. When the external shocks finally came, the Goths, the Persians, the internal structure was too brittle to resist. The empire didn't fall because of the barbarians, it fell because the money died first. Just like the Roman Empire, the Spanish Empire of the 16th and 17th centuries fell into the same trap under Philip II. Spain was the master of the world. They had the strongest army, they had a global reach, and they had a seemingly endless supply of money flowing in from the Americas. Silver from Potosi, gold from the Aztec lands, but this wealth was an illusion. Instead of building domestic industry, the Spanish crown used the silver to fund endless wars and import luxury goods. They outsourced their production. They relied on foreign credit. The influx of silver caused the price revolution. Costs soared. Spanish goods became uncompetitive. The domestic economy withered while the financial aristocracy grew fat on government contracts. The average Spaniard was crushed by the rising cost of living. The crown defaulted on its debt multiple times in 1557, 1575, 1596, when the Dutch and English began to challenge Spanish naval dominance. The system collapsed. The external pressure exposed the internal hollowness. The empire had spent its future to maintain the appearance of strength in the present. Just like the Spanish Empire, the British Empire in the 20th century faced the same reckoning from 1914 to the 1970s. The British pound sterling went from being as good as gold to a second-tier currency. The costs of two world wars had drained the treasury. Britain became a debtor nation. Yet, for decades, they tried to maintain the illusion of imperial power. They maintained a global military footprint they could not afford. They relied on the sterling area to prop up demand for their debt, but the economic reality was undeniable. Industry was stagnant, debt was high. The pivotal moment came during the Suez Crisis of 1956. Britain attempted to assert its dominance militarily. The United States, holding the financial leverage, threatened to sell off British pound reserves. The threat of a financial crash forced a political capitulation. It was the end of the empire, not on the battlefield, But on the balance sheet, the pound was devalued. In 1967, inflation raged in the 1970s. The British middle class saw their savings evaporated by a currency that could no longer hold its value. The external shock, American financial pressure, simply revealed that the emperor had no clothes. The pattern repeats in 7 distinct stages. Stage 1 is sound money. The nation produces more than it consumes. The currency is backed by hard assets or industrial might trust as high. Stage 2 is overextension. The nation expands its influence. It takes on obligations it cannot fund through taxation alone. It begins to borrow against future growth. Stage 3 is the shortcut. Politicians and central planners realize that raising taxes is unpopular.